Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. High inflation has changed the way many investors manage their portfolios. As one fund manager puts it, those hoping for an inflationary peak and trough rather than a long-term high might need to have a rethink. So, which companies and sectors are providing a hedge against inflationary pressures, and where does gold and real estate fit into it? There's plenty to discuss. Remember, this is general information only, and you should seek professional advice before making any personal investment decisions. Brian Arcese is a portfolio manager at Ford Asset Management. He joins me this morning from Singapore. Brian, welcome to Fear and Greed.
Thank you, Sean. Thank you for having me.
So, we've all heard about inflation, and those of us who are old enough have lived through inflation previously, but inflation is a totally different environment for investors, isn't it? Explain why.
No, it certainly is. I think that's a fantastic question. But obviously, for the past 15 years, central banks around the world have largely been fighting deflation. Even most portfolio managers haven't been managing their funds long enough to have managed through a significant period of inflation previously. But it's obviously incredibly important. And the main reason that it is it erodes your purchasing power. And as an investor, it erodes your capital. So you need to invest in a way where you earn a return higher than inflation. You need to earn a quote unquote real return.
Okay, so how does this change the way an investor should approach their portfolio?
So in our minds, there are a few things investors can and should do. If you look at equities in general, they are a reasonable hedge against inflation over the long term, but it's very important to focus on equities that have real pricing power. So they either own real assets, for example, or they have a strong brand. They have the ability to price at least in line with inflation, if not higher. So if you invest in those high quality companies that can do that, then at least over the longer term, that will result in a portfolio that outperforms inflation. Now, during periods of higher accelerating inflation, equities can be volatile. And so other asset classes, like commodities, for example, or equities that would be linked to commodities, might provide investors with a more real-time inflation hedge. But equities over the long term are really one of the only asset classes, or few asset classes, that will give you that inflation plus return.
Okay, so let's just deep dive into equities a little bit further in terms of pricing power. So you're talking about it might be, and listeners, please seek professional advice for your own personal circumstances. So, any names we're using here may not suit you, but it may be a toll road operator, for example, whose pricing is linked to inflation within the jurisdiction it operates. Or it might be someone who basically has a near monopoly on a good or service which people are prepared to pay higher prices for. Is that the sort of thing you're talking about?
That's absolutely correct. In some companies, for example, even industrial companies, may have contracts with inflation linkages directly in them. So if we look at a high quality company called Air Products that's domiciled in the US, it's an industrial gases company. So they supply not only cyclical gases to the industrial commodities complex, but also gases like oxygen, for example, to hospitals. So it's also a defensive company. But directly within their contracts, they have links to inflation. So not only is the brand strong and the company well managed, but you can see directly in the contracts that they will be able to price at least in line with inflation. So that gives you a very strong degree of comfort that through time, if you invest in companies like that, you'll be able to compound at least in line with inflation and earn a real return.
Are there certain sectors that an investor should look at first? So I'm not sure that it's almost sort of it's an industrials company, but are there sectors for people out there listening and you want an inflationary linked return in equities? Where should they start looking?
Yeah, so commodities, as I mentioned, it does offer more of a real-time hedge against inflation. So commodities typically run up at least in line with inflation, if not ahead of it. Oftentimes they may even be a driver of the inflation itself. So if we look either within the energy space, for example, there are companies that one could purchase, whether it's a traditional fossil fuel provider or an oil major that the business may be directly linked to inflation, or a commodities company, for example, where commodities broadly tend to be more closely linked to inflation. So companies like a Freeport McMoran, which would be the market leader or one of the two market leaders in copper globally. So those are companies, because the revenue is really directly linked to the commodity price, offer more of a real-time hedge against inflation within an investor's portfolio.
Stay with me, Brian. We'll be back in a minute. My guest this morning is Brian Arcese, Portfolio Manager at Ford Asset Management. What about gold companies? And Australia has a large gold company, Newcrest Mining, which is under takeover offer from Newmont, which is I think it's Denver-based or Colorado-based organisation. In Australia, we talk a lot about gold. Is that a good hedge against inflation?
So we invest in gold in our portfolios as well, though we do so more as a hedge against volatility and geopolitical risk rather than as a direct hedge against inflation. So I think if you look at gold over the long term, it has a lower correlation to inflation than some of the other commodities would provide. So if you wanted to invest in a commodity directly to hedge inflation, then we would suggest a commodity like copper, for example, or even some of the fossil fuel providers. We would certainly recommend investing in gold as well. It's just that in our minds and in our portfolios, it's serving a slightly different purpose and hedging a different risk, which is general volatility and or geopolitical risk, both of which are increasing.
What about real estate? Again, Australians invest in real estate in their own homes. We understand that. And then in a commercial sense, many of us have money in some of the large real estate investment trusts. But we also see plenty of bad news from the REITs, the property companies, on the back of higher interest rates and working from home, etc. Where does real estate fit into the inflation picture?
I think that's a great question. Now, it is somewhat incongruous in that real estate is often cited both as an inflation hedge and as a bond proxy. Now, obviously, when real estate is wearing its bond proxy hat and interest rates are rising, in no small part because inflation is high, then valuations come down. You're obviously discounting future cash flows at a higher interest rate. And as a result of that, cap rates rise and the value of property can decline. Now, that's really what happens in sort of the first period of an inflationary environment. But when you play that out going forward, what you then typically see is that inflation itself starts to really feed its way back into rents, for example, and incomes. So property over the long term is a very good hedge against inflation. It may not feel that way in the initial bout of inflation or when inflation is high and accelerating, but over the long term, there's a sweet spot when inflation is sort of in this 2 to 4% range, when real estate actually outperforms the rest of the listed equity market, for example, and offers and acts as a real inflation hedge.
I can't not ask you, Brian, about tech stocks, only because of the run they've been on in the last 6 months and the fact that Apple's now worth $3 trillion US. I can never get my head around tech stocks. They run and they fall fast and sometimes not always rationally in my point of view. But how do we think about tech stocks in an inflationary environment?
So I think what we saw last year, so when an inflation was most acute and we saw interest rates rising rapidly. So, I mean, we're closer to the end than to the beginning, but certainly experiencing sort of the fastest and most acute rate rise of the past 40 years. So that can be quite problematic for long duration growth companies such as tech. So we saw the sector underperform significantly during 2022. Now that rates are nearing peak, we do think that there are more increases to come, but certainly they're closer to peak than they were 12 to 18 months ago. These stocks have started to perform better. Investors have moved back into long duration, including technology. And we've had a tailwind and excitement around artificial intelligence. Now, in our mind, other portions of the market offer more value than technology companies currently. It's been quite a narrow rally, and not only within technology, but in a small subset, sort of 6 companies within that technology space that have really driven most of the return. So over the long term, it's a fine place to look for investment candidates. But where we sit today, we do think that investors would be better served looking in other sectors first.
Okay, so we're just wrapping this up. So if we're looking at other sectors in terms of equities, what are the ones that you prefer? I mean, we've spoken about commodities and gold companies, but let's leave commodities out. What are some of the sectors that you would prefer most?
Sure. So for us, the energy and materials space, which would include companies like an Air Products, so not directly linked to commodities, for example, comprise sort of 20+% of our portfolio. And that's a very meaningful allocation if you take, for example, that those two sectors combined in a global equity benchmark are in only the high single digits. So relative to how the benchmark is constructed, we're quite overweight there. Now, each of the companies that we invest in need to be high quality, sound investment candidates from a bottoms up standpoint in their own right. So it's not only a top down allocation, but really when you look at the opportunity set across all sectors today, those are the ones that are screening the most attractive and where in our minds, investors should start to turn over rocks and see what companies within there may be appealing to them or fit their own investment profile.
Brian, thank you for talking to Fear and Greed.
Thank you.
That was Brian Arcese, Portfolio Manager at Ford Asset Management. This is the Fear and Greed Daily Interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.